So today we're going to dive into the, let's be honest, pretty chaotic world of DeFi. That's decentralized finance. But we're going to look at it through the lens of one of the oldest stories we all know, the hare and the tortoise. And you know what? It turns out this ancient fable has some seriously powerful and profitable lessons for today's crypto markets. Let's see how.
And this image, well, it just perfectly captures what we're talking about, right? On one hand, you've got this timeless, solid wisdom. On the other, the super fast-paced, cutting-edge world of DeFi. So the big question is, can the old wisdom really guide us through the new tech?
It's a pretty wild question when you think about it. You see all these stories online, overnight millionaires, insane gains. But what if the real strategy for building lasting wealth in crypto has nothing to do with speed? What if it's all about endurance?
Okay, so let's frame this whole thing as a tale of two investors. Each one has a completely different philosophy, and we're going to personify them with our two classic characters. So on one side, you've got the hare. This investor is all about speed. They're using leverage, which is basically just borrowed money to make their bets bigger. They go all in on whatever's hot, totally driven by FOMO, the fear of missing out. Then, on the other side, you have the tortoise. Their game is patience, discipline, real diversification, and above all else, protecting their capital. Two completely different paths, and they lead to two very, very different destinations. Let's dig into the hare's strategy first. Their whole high-speed approach is built on a foundation of really risky gambles. And spoiler alert, it almost always ends in the exact same place. Total disaster. The hare's first and maybe biggest fatal flaw is an addiction to leverage. Just look at the 2022 crash. A mind-blowing $40 billion in leveraged positions were just wiped out, liquidated. That's not a paper loss you can recover from. That's money that vanished from people's accounts. Poof, gone, forever. And the math here is just absolutely brutal. If your portfolio drops by 50%, you need a 100% gain just to get back to even. When you're using leverage, even a small dip can trigger a total wipeout. You get a margin call, you're forced to sell at the worst possible moment, and that guarantees you will never, ever get a chance to see the recovery. It's game over. So what's the hare's second mistake? It's chasing these absolutely absurdly high yields. You see a number like 150% APY, right? Annual percentage yield, and that FOMO just kicks right in. It feels like you found a cheat code, free money, a secret way to get rich quick. But here's the thing, it's almost always a trap. So this is the crucial question you have to ask yourself every single time. If it looks too good to be true, it probably is. That yield has to come from somewhere, you know? It's not magic. And the answer is usually something you really don't want to hear. Most of the time, that incredible yield is just a classic house of cards. It's being funded by new investors paying off the earlier ones. A Ponzi, basically. Or the protocol is just printing its own token like crazy to pay you, which tanks the value of your actual investment. Or, worst of all, it's fueled by some kind of hidden leverage that's just waiting to blow up the whole system. Bottom line, it's not sustainable. And this might be the hare's biggest illusion of all. It's this illusion of diversification. They think owning 20 different speculative altcoins means they're safe. But when every single one of your assets is in the same super volatile asset class, you are not diversified, not even close. And look, we've got data on this from the traditional stock market, and it's pretty scary. About 40% of all individual stocks suffer a permanent decline of over 70%. Now think about crypto, where all the tokens are even more correlated and tend to crash together. The risk is just through the roof. You're not diversified, you're just making one big concentrated bet on a single market trend. Okay, so that's the hare's road to ruin. Pretty bleak, right? So now let's flip the script. Let's look at how the tortoise builds a completely different outcome with a simple, powerful, and almost boringly effective set of tools. The tortoise's entire strategy, the whole thing, starts right here, with the absolute bedrock of survival, position sizing. The rule is simple, but it is non-negotiable. No single investment, no matter how much you love it, gets to be more than 5% of your total portfolio. This guarantees that if one of your bets goes completely to zero, which can happen, you live to fight another day. It is all about survival first, growth second. Now this is what real diversification looks like. It's not 20 different kinds of crypto. It's a mix of genuinely different assets that don't all move together. You've got stocks, bonds, REITs, which are kind of like stocks for real estate, and yeah, a small, carefully chosen slice of crypto. The whole idea is that when one part of your portfolio is down, another part can be up, which smooths out the whole ride. And now for the tortoise's secret weapon. You ready? It's patience. That's it. History shows us over and over and over again that trying to time the market, jumping in and out, is a loser's game. Some of the biggest gains in history happen in these short, unpredictable bursts, usually right after the worst crashes. The people who win are the ones who just stay in the market. They endure the scary parts, so they're there for the recovery. So we've got our two investors. The hare, leveraged up to the eyeballs, all in on a handful of bets that all move together. And the tortoise, patient, diversified, and playing the long game. Now let's see what happens when that inevitable market storm finally hits.
And it always does. No market goes up in a straight line forever. Volatility isn't a maybe, it's a certainty. The only real question is whether or not your strategy was built to handle it.
And here it is, the climax. For the hare, the downturn is absolutely catastrophic. That same leverage that made him feel like a genius on the way up now guarantees his total destruction on the way down. Margin calls, forced liquidations, portfolio goes to zero. Game over. But the tortoise? Oh, their portfolio takes a hit for sure. They definitely feel the rain. But because they have no leverage and they're truly diversified, they survive. They just keep moving forward. So what's the big moral of the story here? For anyone investing in the wild west of modern DeFi, what's the key takeaway from all this?
It's actually pretty straightforward. If you want to be the tortoise, you follow these 5 simple rules. 1. Avoid leverage that can wipe you out. 2. Be super skeptical of yields that seem too good to be true, because they are. 3. Diversify into assets outside of crypto. 4. Keep your position sizes small and conservative. And 5. Have the courage to just hold on when everyone else around you is panicking.
Now, this entire framework is inspired by the fantastic work being done by Sagic's Apothecary. They do a great job of blending that timeless financial wisdom with a really sharp analysis of modern markets. So if you want to dive deeper into these kinds of strategies, you should definitely check out more of their research.
And I really just want to leave you with this final thought. In investing, and especially in crypto, the goal isn't to be the fastest. The real goal is just to survive, to build a strategy that makes sure you're still in the race, ready for the next opportunity, long after all the reckless players have burned out. Stay safe out there. Thanks for listening.